is very simple. You are allowed to use at least 3 indicators since you're not premium. It's when you subscribe for the premium that you can use more than 3. So right now you have 3 indicators. So all you need to do is just come to the FX here on TradingView. You search for Evans. You type it EVAN. Then every strategy and indicator that he has done will be displayed there. So we just need 3 right now. Since we are only allowed to use 3, right? So now, normally I will explain each of the indicators one by one. But since we are only allowed to use 3, so these are the 3 you are going to use. You pick the Evans Cabral binary strategy 2. Then you pick the Cabral stock RSI with alert. This is the 2 that you need here for now. These are the 2 that you need here for now. Now, you now come here and type DMI again on the search space of DMI. So we are taking the first DMI stochastic, the first one there. So you pick that as well. So that will make it 3 that you need. So by the time you choose all those, the only thing that is going to display on your screen is what you are seeing here right now. I'm actually on premium, that's why I have these other indicators. But without the premium, you can still get this 3 right here. This is the Ever Cabral Strategy 2. On the first one that we chose. This is the stock RSI with alert. Then this is the DMI extreme that you chose that. So now with these 3, you can still take your trade, and these 2 are meant to be separate. They are both stock RSI. Do you get that? We are allowed to use more than 3 normally with the strategy. One of the stock RSI will be on top, the other will be in the middle. That will make it like 2 stock RSI, then this DMI at the bottom. But since we are not on premium and we want to utilize it, I think that's one of the main reasons why this guy has done these 2 together to be 1 indicator. He actually did another one. That one is the that's the oscillator there. So he actually combined the 3. This stock RSI, the 2 stock RSI combined with this DMI, we combine the 3 into 1 single indicator. So if you come here and you type Evans, right? This oscillator that you're seeing here, it consists of this stochastic RSI for Evans Cabral Strategy plus the DMI. The 3 are in here. So are we together? So if after you've gotten how this thing works, if you don't want to add these 2 on a different level, you can actually go there and choose that one. It will act as a single indicator. So that will even give you an opportunity to add another indicator to make it the 3rd one. But I actually want to use these two differently so that you guys can get the concept of the strategy easily. If the 3 are together, it will be kind of hard for you to get. So that's why I'm doing this. So these are the 3 that we need since we are not on premium. So you can still take your trades with these 3 alone. So now how does the strategy work? It is very simple. Now we all know in Forex, we have uptrends and downtrends, right? We have uptrends and downtrends. We will still go through marking up. I know some of you already know talks about marking up. So now, adding marking up your charts will actually help you more with this strategy, because once you've marked up your chart before putting all these indicators, it will let you see the clear picture of what is happening. So now, although the 200 moving average, which is this line you're seeing here, this purple line, is pointing down. Whenever the market is below it, that means you are on a downtrend. Whenever the market is above that 200 moving average, that means you are on an uptrend. This market has been on a downtrend for a very long time. But here we can see the market was above. That means this from here down here was an uptrend before it came down below it again. So now, whenever you see the market below this purple line, you are on a downtrend. Actually, you are to mark up your chart before you put on these indicators. You already have a trend line for a downtrend on this kind of movement. We're on the 5 minutes right now. So now, once you're on the indicator, the first thing you have to take note of is the market above that 200 moving average or below? If it's below, we're on a downtrend. And whenever you're on a downtrend, you are looking for sales. We are looking for puts. You take more puts and less calls. You take more puts and less calls because we are on a downtrend. We go with the trend. You know, we are binary traders. We are small time day traders. We are not going to be in the market for long like a traditional Forex trader. The difference between us and traditional Forex traders, they take trades, and at times their trades take hours, days, weeks before it goes their way, and it won't affect them. But we need our own trade, our prediction to go our way in a little amount of time. We don't have enough time. It has to go our way within the time limit we are trading it. So it is advisable for us to go with the trend because there is more force with wherever the market is going at that particular time. Most of our time limit that we do is 10 minutes, 5 minutes, highest, maybe 15 or 30 minutes. So it's better for you to just follow the trend. If you are trading against the trend, you can do it. I do it most of the time, but I know I have limited time to take that trade. So normally I don't roll over more than twice, because if it's not going my way, for that time, I know it's obviously maybe the market has left already because I'm trading against the trend, which is not advisable. So most of the time, it's just better to be patient with the market to give you an opportunity to take a trade with the trend. So now, if the market is below the 200 moving average, we are looking for sales, right? So if you are seeing a call opportunity, you have to wait. You can take it. I take it most of the time, like I said earlier, but it's better for you to wait for this selling opportunity and sell. You will even have more confidence because at that time, you know the currency pair at the back is stronger than the one at the front. So the pair at the back, which is the HOD in this case, we are trading euro HOD. This chart is euro HOD at this moment, right? So the HOD at the back, HOD is stronger than the euro, right? So it's better for you to wait for the opportunity whereby the HOD will push the market downward. Whenever you see a downward movement, that means the one at the back is stronger than the one at the front, right? So it's better for you to wait for the fall than take the fall. If you are taking the fall, don't let it be too much. You take it with, like, obviously you know you're risking, so don't risk a lot trading against the trend. So now, how does the strategy work? It is very simple. Now this indicator at the top here consists of the Bollinger Bands. We have the Bollinger Band, the upper Bollinger Band, the lower Bollinger Band, then we have a single moving average in between the two. That single moving average between is the 20 EMA. The 20 EMA. The purple moving average that you see at the top is the 200 EMA. So now, that is what, then we have the support and resistance, automatic support and resistance that will be formed as the market is going. So if you have resistance, that's the red line that you see that are created each time. Then the blue line are the support that are created as the market is going. Wherever the market is being rejected is where these lines are formed as the market is going. So that is just what is there in the first layer. So now the second layer consists of two stochastic RSI, like I said. If you come to the FX layer and you type stochastic RSI, you see it. This is the second thing here. If you press it to come down, obviously, but we can't do more than 3, right? So now instead of doing this, pressing that stochastic RSI twice, because we need 2 of it for this strategy right now. Instead of doing it, instead of putting the 2 right here, which this free plan won't allow us. We have Evans who has put the 2 together for us. So now, the 2 consists of the 2 settings are there already, right? We have the fast one and we have the slow one, which is what we need. Already, if you are going to do the 2 normally, you set one to be a fast stoch RSI, then you set the other to be a slow stoch RSI. The setting for the slow is leaving the length RSI to be 14, then the second one to be 14. But for the fast one, all you need to do is put the fast RSI to be 5, then the stoch to be 5 as well. So now, instead of doing it one by one, then you do 5, 5, 2, 2, 14, 14, 2, 2. This strategy has actually made it very easy for you to just have the 2 together. Actually, this is going to be 3, 3. It is while I was like just strict, because in this business, you have to tweak some things to see if it will work more for you. This is how it will come by default. And I want to use it by default to teach us. So that is the default setting. So once you just press that Evans stoch RSI, just leave it at default and it will do the work you want it to do. So now the DMI stochastic is the third one. So now this DMI stochastic is working in line with this stoch RSI as well. But all what we need use the DMI for is just for us to give us this symbol, the sell and the buy. Once the market is ready, it's the DMI that is going to give you that signal to buy or to sell. Very simple. So we use this DMI stoch to know when to enter the market in this strategy. The DMI will tell us when to enter the market. So if the DMI is yet to tell us to go in, we don't go in, we keep waiting. So now, that is the explanation for the indicators that we have here, right? So now, how does the indicator work? Now, to go for a buy in this strategy, to go for a buy, you need to see 3 things. What is the first one? You need to see the market touching this lower bound, this lower Bollinger Band. The moment you see the market entering this lower Bollinger Band red line, moving to that green line, that's the signal to tell you to expect the market to go up anytime soon. So once you see the market around that lower bound, we are expecting a reversal, right? We are expecting a reversal to take a call. But we can't just take a call just yet. We have to look for other confirmations. So now we are looking for other confirmations. Let's say at this particular time, this is when the market is around this. So now what do? We come down to the stock RSI here. We want to see both the fast and the slow RSI crossing this red line here. This oversold RSI, oversold line, red line. We want to see both crossing, both must be down below the oversold line. Once this two crosses this line, that means the market is oversold already. We are expecting a reversal. We are expecting a buy, right? That's the second confirmation we are looking for, which is what we can see here right now. We can see that both actually crossed in this market right now. The market is at the lower band, right? The two RSI have crossed down here. Now, what is the third thing that we need? The third thing we are looking for once we have two confirmations already is to see this DMI stochastic. The black line there has to cross down as well. What are the three things I said? The first one, the market is touching the lower Bollinger Band. The second one, the both fast and slow stock RSI are crossed down the oversold line, right? Then the DMI stochastic line has crossed down the oversold line as well. So we have the three levels on the oversold already. We have the three levels on the oversold already. So we have this, right? We have this. The market is touching the lower Bollinger Bands. The two stock RSI have crossed down. The DMI stochastic has crossed down. So now we are expecting a reversal. Okay, now, how do we know when to enter? First thing first, the moment this market right here was rejected here, this blue line would have been created for you. This blue line would have been created for you because once the market is rejected at the point, the blue line automatically creates itself. That's why I said it is an automatic support and resistance. So now, but the issue is you can't use that alone to take your trades because it's changing. After the market goes down, then it disappears. That's why you need other confirmations to take your trade. So now, you know, the moment you see this blue line, you get the price you are looking for to take your trade. So once it was rejected here, before the market came back here already, you know that the moment this market is coming back at the line of that level, you are ready to take your buy. But you need other confirmations, right? So that's when you come to the second layer, which is here. So now here, once the two are crossed down, we are not really concerned about the screw again, which is the orange Bollinger Bands, right? We are concerned about the fast one. Because the fast one will move up first when the market is reversing before the slow one will. We are actually concerned about the fast one, which is the 5-5, right? So now, the moment the two are crossed down, we are not actually concerned about the slow one because at times the slow one will still be here, the fast one will move up, and the market is already going up already. So we are not concerned about the slow one again. Once the two are crossed the line, we are only concerned about the fast RSI. So the moment you see this fast RSI, the two green line crossing back this red line up, the market is reversing. Now, You have the two confirmations already. You know where to enter, right? Which is where this blue line was created. That's where to enter. Once you see this thing, the fast stock RSI crossing back, you know you are getting into the market, right? Now, how do you enter? You come to your DMI stochastic, right? The moment you see the DMI stochastic crossing, the moment it's touching this red line is when this buy will be formed. The moment it touches this red line that you're seeing here is when this buy is formed. The moment you see this buy, you enter the market. Now, the BMI stochastic has given you a go ahead to buy, right? Where are you buying? At the market price of the blue line is where you are entering the trade, which is, if you can check right now, it's 587. That's the last 3 digits I'm calling. So those are the 3 conditions that should be met before you go for a buy. Those are the 2 conditions that are met before you go for a buy. So let's go for that of a sell. It's just the opposite. Very simple, right? You can see a sell right here, right? Now, what do we need to go for a sell? First things first, to go for a sell is after you bought, it's 2 ways. If the market just touch the lower Bollinger Band and the market is moving to the middle Bollinger Band, that is the 20 EMA, that single line in between. If the market is moving to that place and is touching it, it is most likely for the market to reverse if you are on a downtrend. Because what happens on a downtrend is market reverses more on that middle line than in the situation whereby it will come to the upper band before it reverses. So now, if the market is touching the middle line, you have your first confirmation, but you need other confirmations before you take your trade. The 2 spoke RSI have to cross the upper overbought line on the stock RSI. The 2 has to cross. That's the second confirmation. The first confirmation is the market is touching either the middle line or the upper band. That's the first confirmation. The second confirmation is the market has crossed the overbought line. The 2 stock RSI have crossed the upper band. Then the last confirmation is the DMI stochastic has crossed the overbought as well. So how do we know when to enter? This green line that you're seeing right here, the moment this wick was created, this red line is already formed. So you have your entry price that you're looking at, right? Now, the moment you see the fast stock RSI crossing back, the moment you see it crossing back from that overbought, that means the market is ready to sell. How do you enter? Instantly when this DMI stochastic is touching this line, this sell will be formed, which will give you this red candle that you're seeing right here. So if you entered at this market price right here, where this candle is from, you will win your trade. You know, we are not going for more than 5-10 minutes. Even if you go for 10-15 minutes, you will still win this trade because the market did not come back to that entry price, right? There are so many, if you check from behind, you will see so many things that have happened. Here, the market was touching the upper band here. This has crossed, not fully, but it was touching. But the DMI stochastic actually crossed and gave that sell. And the market did well, eventually it fell. Okay, let's look here again. Here, the market is touching the lower band for a buy. The 2 actually crossed. the first one moved up, that's the buy signal. The DMI stochastic crossed down and came back up and gave that buy signal. If you enter the market, that is a very good profit for you. So it's something you can just try and look for. Obviously, it's not going to work every time because nobody can predict the market 100%. There are times whereby the market will just do it and show you that you can't predict it or right all the time. But where our own advantage is we predict correctly more than the ones we lose. And if you can have 80-70% win rate, obviously you are going to be profitable in this business. So you have to, the only advantage we have is the higher probability of winning with your personal strategy that you're sure. You do your own work right, you do everything right, and you wait for the market to either respect it or disobey it. It is obviously going to respect it more than the time is going to disobey it, right? Okay, I'm seeing another perfect one right here. This was touching the middle line. The 2-year actually crossed up. The DMI stochastic has crossed up and gave the sell signal on this big red candle that you're seeing here. And the market did what? Came down. It is a very simple strategy. You just need to see those 3 things happen, then take your trade. Now, on the next video I'm going to do, I am going to teach how to mark up with this strategy to have more confirmations to take your trade. Because obviously, if you have your markup on this chart right now with this strategy, it will help you avoid more losing trades. Obviously, even if you don't use markup and you use just these 3 principles, 3 confirmations, you are obviously going to have more wins than losses. But just to reduce the losses more, if you have your markup to this chart, it is going to help you now. So is there any question? That's just the 3 confirmations you need to look for. To go for a buy, the market has to be touching the lower bound. The 2-stop RSI has to cross below the oversold line. And the DMI stochastic has to cross below the oversold line as well. Once those 3 are done, we are waiting for a what? A buy. So now how do you know when to get in? You check the price at the support, automatic support line that is created by the strategy on the first layer. That will be your entry price. Then you wait for your fast stop RSI to cross back up the oversold. That's the second confirmation. Then you wait the final confirmation, which is even going to give you the entry, the time to enter, is the DMI stochastic. Once the DMI stochastic gives you that buy, you go in. That's the top confirmation. Then we must not forget, it is better for you to take in this kind of market that we know that the market is below the 200 EMA. That means the market is on a downtrend, right? It's better for us to wait for this market touching either the middle line or the upper line, upper Bollinger Band, waiting for the 2-stop RSI to cross the overbought and the DMI to cross the overbought, so that we will only take sales. Okay, now check for example here. Starting from here, right? We sold here, we will sell here, that's 1. We are going to sell here, that's 2. It was crossed here, we will sell here, that's 3. So you will have more sales even than buying, and you have more win rates if you are following the trend than going against the trend. And this is not limited to just one pair. If you put any pair here, it's going to work. Once you load any pair of, this is EOJPY. Once you load any pair of, it's the same thing. Everything is the same thing. The market was below the line here. This was touching the middle Bollinger Band. The two stock RSI are crossed off. DMI stochastic crossed off. It gave a sell signal. See what the market did. The market came down. That's a massive profit for you. You are not going to be in the market for long. We are binary traders, right? So it's as simple as that. Very simple and straightforward. It's an amazing strategy. Actually, come here on the Evan Cabral. Just type Evan, EVAN. Then if you press this Evan Cabral oscillators, it will give you both the stock RSI, the double stock RSI, and the DMI stochastic, the two together. These two indicators are going to are combined as one. So since you understand the concept of what you are waiting for, you actually use the three together in one single indicator. That will give you an advantage. That will give you a chance to add even one more indicator to this chart. It's going to give you an advantage to add one more indicator to this chart. So these two are going to stand as one indicator, and this one will stand as one indicator. So you have one more indicator that you can actually add to the chart. Okay, now check this latest. The market is actually running now, but check this one right here. You can see that the market was touching the lower Bollinger Band here. These two have oversold for a very long time. So now around this point right here, they both actually moved back up to the line, and the DMI stocks actually crossed back and gave the buy signal. See what the market did? It came up straight. It's as simple as that. It's as simple as that. That's what we're doing with this strategy. That's what we're doing with this strategy. That is what we'll do with the strategy. So we'll do the markup with the Evan strategy in the next video. So you can see how you can avoid some trades that are not ready yet more. So that will cut your losses and increase your win rate. Thanks for watching.